Imagine a single entity holding the power to steer the global economy. Yes, an institution that can make or break nations. That's the Federal Reserve Bank for you. The Federal Reserve, often referred to as the Fed, is a force to be reckoned with. Its omnipresence in the world of finance is undeniable. Born out of a financial crisis over a century ago, it's the central banking system of the United States, a country known for its economic might. The Fed is like the beating heart of the U.S. economy. Its pulse echoes throughout the world, impacting economies near and far. Whether it's setting interest rates, controlling inflation, or regulating the nation's banks, the Federal Reserve's influence permeates every corner of the economy. But the Fed's reach extends beyond the U.S. borders. It's a global powerhouse with decisions that reverberate across the international financial landscape. When the Fed sneezes, the world catches a cold, so to speak. Its actions can send stock markets tumbling, currencies fluctuating, and economies into recessions. The institution is made up of a network of 12 regional Federal Reserve banks spread across the U.S. Each of these banks plays a crucial role in the nation's financial health, contributing to the overall strength and stability of the U.S. economy. At the helm of the Federal Reserve is a board of governors. These individuals are appointed by the president and confirmed by the Senate. They're the ones who make the big decisions, shaping the financial future of the nation, and by extension, the world. And let's not forget about the Fed's power to lend money to the U.S. government. This ability to influence the money supply is a significant part of the Federal Reserve's arsenal. It's a tool they can use to stimulate economic growth or to keep inflation in check. So, the Federal Reserve is no ordinary bank. It's an institution with a reach and influence that's truly global. Its decisions affect everyone, from the Wall Street banker to the small-town farmer, and from the tech giant in Silicon Valley to the shoemaker in a remote village in Africa. But how did the Federal Reserve come to wield such vast power? Our tale begins in the year 1913, amidst the bustling era of financial reform. The United States was seeing an unprecedented wave of industrial growth and urbanization. However, this rapid progress was often punctuated by financial panics. The need for a more stable, centralized financial system was becoming increasingly apparent. Enter the Federal Reserve Bank, an idea conceived amidst the stormy seas of financial uncertainty. This institution was unlike any other. It was not quite a government agency, yet not entirely a private entity either. It was something in between, a unique hybrid designed to serve the public interest while remaining insulated from political pressure. The key figures who breathed life into this concept were a diverse group of visionaries. Among them were President Woodrow Wilson, who signed the Federal Reserve Act into law, and Senator Nelson Aldrich, who led the charge in Congress. They were joined by a cadre of bankers, economists, and politicians, each bringing their own expertise and perspectives to the table. The context of the Federal Reserve's creation was a complex tapestry of economic and political forces. The United States was moving away from its agrarian roots and becoming a global industrial power. Yet the nation's banking system was fragmented and prone to instability. Financial panics, bank runs, and economic downturns were all too common. The Federal Reserve was born out of the need to bring stability to this chaos, to be the lender of last resort, and to provide a safer, more flexible and more stable monetary and financial system. This was no small task. It required the careful balancing of various interests, the successful navigation of political hurdles, and the foresight to create a system that could adapt to the ever-evolving economic landscape. The Federal Reserve was not just a bank, it was a symbol of progress, a testament to the ingenuity of its creators, and a promise of economic stability for the American people. Thus, the Federal Reserve Bank, the brainchild of visionaries, was born. From a single entity, the Federal Reserve expanded into a network of 12 branches across the United States. These branches, strategically located in key cities, are the veins that help circulate the lifeblood of our economy, money. From Boston to San Francisco, each branch serves a specific region, ensuring the economic health of the nation. Now you might wonder, what exactly do these branches do? Well, they're quite the multitaskers. They implement monetary policy, supervise and regulate banks, and provide financial services. In essence, they're the watchdogs and caretakers of our financial system. Each branch operates independently, yet under the watchful eye of the Board of Governors in Washington, D.C. This setup ensures a balance of power and autonomy, keeping the system flexible and responsive to the unique needs of their respective regions. But who calls the shots in this vast network? At the helm of the Federal Reserve are 7 governors, each wielding significant power. Pivoting to the top tier of the Federal Reserve structure, we encounter 7 individuals, the governors, who are bestowed with the responsibility of guiding the nation's monetary policy. These individuals are more than just figureheads. Their decisions influence the ebb and flow of the country's economy, impacting everything from inflation rates to employment levels. Each governor is appointed by the President of the United States and confirmed by the Senate, serving staggered 14-year terms. This lengthy tenure ensures that their decisions are free from short-term political pressures. It's a marathon, not a sprint, as they say. The governors are the core members of the Federal Open Market Committee, or FOMC. This committee is the one pulling the levers of the economy, deciding when to increase or decrease interest rates. A hike in interest rates can cool off an overheating economy, while a cut can stimulate growth during a slowdown. It's a delicate balancing act requiring a keen understanding of economic indicators and a steady hand. One of these 7 governors is chosen as the chair of the Federal Reserve, a role that is often seen as the most powerful position in the world of finance. The chair, selected for a 4-year term, acts as the face of the Federal Reserve, communicating its actions and intentions to the public and the government. The influence of these governors extends beyond the borders of the United States. Their decisions reverberate around the globe, affecting international trade, foreign exchange rates, and global financial markets. It's essential to note that while the governors have substantial power, they are not omnipotent. Their decisions are influenced by a multitude of factors, including economic data, market conditions, and the advice of their staff. So, while the Federal Reserve may seem like an abstract institution, it is in fact a group of individuals making decisions that impact our daily lives. The 7 chairs at the table are filled by individuals with the weighty task of steering the American economy. These governors hold the key to America's financial destiny. The Federal Reserve is America's lender of last resort, but how does it lend the money to the U.S. government? The process is not as straightforward as one might think. The Federal Reserve doesn't just hand over a bag of cash to the Treasury. Instead, it begins with the U.S. government issuing bonds. These bonds are essentially IOUs, a promise to repay a specific amount of money at a later date with interest. When the government needs more money than it has on hand, it sells these bonds. The buyers can be anyone from individual investors to foreign governments. However, a significant portion of these bonds are purchased by the Federal Reserve. The Fed pays for these bonds by crediting the accounts of the banks where the bonds were purchased from. This is, in essence, creating money. Now you might be wondering where the Federal Reserve gets this money. The answer is quite simple. They create it. Yes, you heard it right. The Federal Reserve has the power to create money. It's worth noting that this isn't just about physically printing notes. The vast majority of money in the modern economy exists as digital numbers in bank accounts, and the Federal Reserve can create this money with a few keystrokes. The Federal Reserve also has the power to adjust interest rates, which has a significant impact on the economy. If the Fed wants to stimulate spending and investment, it lowers interest rates, making borrowing cheaper. If it wants to cool off an overheating economy, it raises interest rates, making borrowing more expensive. This is a delicate balancing act, as getting it wrong can lead to recessions or inflation. In essence, the Federal Reserve's lending to the government involves buying government bonds and creating money, which then flows into the economy. The Fed's control of interest rates allows it to influence how much borrowing and spending goes on in the economy. The Federal Reserve's lending practices are a balancing act of epic proportions. The Federal Reserve, while a beacon of financial stability, is not without its downsides. The Federal Reserve holds a powerful position in the American economy, but this power is somewhat of a double-edged sword. On one hand, the Fed is a blessing. Its ability to adjust interest rates and control the money supply has proven to be fundamental in stabilizing the economy. It can cool down an overheating economy by raising interest rates, or stimulate a sluggish one by lowering them. It's like a pilot navigating turbulent skies, adjusting the altitude to find smoother air. Moreover, the Fed's role as the lender of last resort is significant. In times of financial crisis, it steps in to provide liquidity and prevent a total economic meltdown. We saw this in action during the financial crisis of 2008, when the Fed intervened to stabilize the financial system. But this power comes with a price. On the other hand, the Fed is also a curse. It plays a significant role in the accumulation of the national debt. When the government spends more than it earns, the Treasury Department issues bonds to cover the difference. The Fed, along with other investors, buys these bonds, effectively lending money to the government and increasing the national debt. Furthermore, critics argue that the Fed's ability to create money out of thin air leads to inflation, eroding the purchasing power of the dollar. This means that over time the money in your pocket buys less and less. And while the Fed can stimulate the economy by lowering interest rates, this can also encourage excessive borrowing, leading to bubbles in asset markets. When these bubbles burst, they can trigger financial crises, just like the housing bubble did in 2008. In conclusion, the Federal Reserve is a vital institution, but it's not without its flaws. It provides much-needed stability and liquidity in times of economic turmoil. But its actions also have unintended consequences, contributing to national debt and potential financial crises. The Federal Reserve is a double-edged sword, providing stability but also contributing to national debt. The Federal Reserve doesn't just affect the United States, it's a puppeteer pulling the strings of the global economy. Often, the ripple effects of the decisions made by the Federal Reserve echo far beyond the American shores. When the Federal Reserve tweaks the interest rates, it's not just the American borrowers and savers who feel the impact. The tremors are felt across the globe, from the bustling markets of Tokyo to the trading floors of London. Consider this. The US dollar is the world's dominant reserve currency. Countries around the globe hold vast amounts of their foreign exchange reserves in dollars. So when the Federal Reserve alters the course of the dollar through its monetary policies, it simultaneously influences the value of these nations' reserves. Moreover, many countries peg their currency to the dollar. When the Federal Reserve changes the monetary policy, these countries are often compelled to follow suit to maintain their peg. This puts the Federal Reserve at the helm of their monetary policy, whether they like it or not. Now, who holds the reins of this mighty institution? The most powerful person within the Federal Reserve is the chair. The chair is nominated by the President of the United States and confirmed by the Senate for a term of 4 years. They have a pivotal role in shaping U.S. monetary policy and, consequently, the global economic trajectory. The current chair, with their astute understanding of the economic landscape and strategic decision-making, wields the power to steer the global economy. Their decisions can cause stock markets to soar or plummet, affect employment rates, and even influence the economic policies of other nations. It's a role of immense responsibility and influence. It's fascinating, isn't it? How the decisions made in a boardroom in Washington, D.C. can reverberate across the world, affecting lives and livelihoods in far-off places. It's a testament to the interconnectedness of our global economy and the towering role the Federal Reserve plays in it. The Federal Reserve, a seemingly omnipotent entity, continues to shape our financial future. The Federal Reserve, a powerhouse of economic control, raises thought-provoking questions about power and responsibility. As we take a step back and observe the intricate web spun by this financial behemoth, the sheer magnitude of its influence has been brought to light. Reflecting on the establishment of the Federal Reserve back in 1913, we see the birth of an entity that would come to hold immense power over the United States financial landscape. The orchestrators of this endeavor, a group of ambitious and visionary individuals, set the stage for a financial institution that would evolve and grow into the complex system we see today. As we navigated through the 12 regional branches that span across the United States, we uncovered the layers of governance that oversee this institution. 7 governors, each appointed by the President and confirmed by the Senate, control the monetary policy decisions that ripple out across the nation and beyond. The Federal Reserve's ability to lend money to the U.S. government, to print notes and to influence interest rates underlines the potency of its operations. Yet, these powers are not without their caveats. The blessing and curse of the Federal Reserve is a paradox that we must grapple with. The U.S. government's staggering debt, and the role that the Federal Reserve plays in managing this, is a testament to the institution's influence. Yet the Federal Reserve does not operate in isolation. Its actions reverberate across the global economy, pulling the strings in a complex dance of financial interdependence. The role of the chair of the Federal Reserve, as the most powerful individual within the institution, is a position of immense responsibility. Elected by the President for a 4-year term, this individual holds the reins of an economic powerhouse. Who should hold the reins of such vast financial power and how should they wield it? It's a question for all of us to ponder. As we delve deeper into the workings of the Federal Reserve, we are left with more questions than answers, demonstrating the complexity and importance of this financial institution.